All right. Yeah, let's dive right in. Our guest today is a special one. So, Claudia Sahm, and an economist best known for creating the Sahm Rule, a famous tool for predicting recessions during her extensive time at the Federal Reserve. And she currently serves as the chief economist at New Century Advisors, leading research on macro trends. She's also the founder of Sahm Consulting, offering her expertise in fiscal and monetary policies. And she also shares her insights through her popular Substack newsletter called Stay at Home Macro and a regular contributor to Bloomberg. So, Claudia, thank you so much for joining me today.
Yeah, thank you for having me.
Yeah, no, let's dive right in. I appreciate your time. So let's make the best out of that. Yeah, so the first question would be very open, and you can develop on that and let's see where it leads us. But I just would like to get your current assessment on the division that everybody has about where the U.S. economy is going. So we have the soft landing camp, the no landing camp, the hard landing. So, and we have, of course, we're going to talk about the Sahm rule as well. That got triggered, but you didn't feel too confident about that. I got a little bit of that feeling. So, I would like for you to just develop on that. Where do you stand right now on the U.S. economy?
Right. So the US economy is in a good place. And now the question is, of course, where is it headed? And in this discussion, this ongoing discussion about the landings, I think it's important to fix what we mean by the terms. And people have some different definitions, but I'll share with what I think of the term. So I have been through this entire economic cycle in the camp of a soft landing. And a soft landing meaning that inflation would come back down to the low levels that the Fed targets. And we will have that happen with unemployment remaining relatively low. And that has been the trajectory. Inflation in the United States peaked in the middle of 2022, and particularly starting in the second half of 2023, there was a big drop off in inflation. Now, are we all the way back to the 2% target the Fed has set? No, but we have certainly made considerable progress. And the real remarkable aspect of it, and something that most people said was not possible, was that we had that drop in inflation with the US labor market remaining strong. It softened some, but it stayed very strong. And we have not just avoided a recession, we have had the opposite of a recession, which is in the past 2 years, real GDP growth in the United States. So even after you take into account inflation, has been running a good bit ahead of where it was the pre-pandemic pace. So we've had that soft landing, if you think of that in terms of inflation back down, unemployment stays low. Now, of course, there are always risks around the path going forward. And the people who, I think particularly the no landing camp, which that's one of the people have different definitions of no landing. Again, I do this all in terms of inflation and unemployment. But a no landing would be inflation just stays high. Like say we would get stuck. Like we're not all the way back to a 2% target. We're very much in like getting there. But say we were to get stuck, or even there was some reinflation, and yet the economy keeps growing, right? Unemployment stays low, the growth. So that's the no landing camp, that we just really don't get the inflation back down. I think at this point, to have that happen, you have these stories of reinflation risk. Now we do have some policy changes coming post election, which might be inflationary, right? And so there's a lot of discussion about the tariffs as one example, and maybe the larger budget deficits as another, have caused some concerns of inflation coming back. But that's like a new development. That really doesn't quite fit in the discussion we've been having about soft landing, no landing, hard landing. Like anytime we have a new development come up, like that opens up a whole new space. But even there, I think, we just don't know enough yet to make that discussion. And the third group, the hard landing, which has which was a very popular outlook when inflation was high. Like we'd have to have a recession to get inflation down. We even needed a recession to get inflation down. There were some economists who said that. Well, that group has really taken it on the chin, in the sense that the US economy has proved quite resilient. Now, I will say, over the summer in the United States, there were at different points kind of a growth scare. And we did have some places at points in time in the summer where the unemployment rate really moved up, or the labor market looked like it was slipping. we have seen a cooling off in the labor market. The Fed has told us they don't want more cooling. But, the reality is the trajectory has been to some softening. So I wouldn't say like the hard landing is not, well, it's certainly not my base case and it hasn't been, but we have seen some softening in the US economy, but more of up to this point, it has looked more like kind of a moderation coming out of a very tumultuous time as opposed to the bottom falling off. So I've been soft landing. I continue to be in that space. There are clearly some policy developments on inflation to keep an eye on. And then, I'm not going to rest easy until I see the labor market really stabilize. Like the cooling is not worrisome at this point, but the fact that it hasn't kind of leveled out is, I think, potentially a problem.
Fantastic. Yeah, many segues out of that. So you already mentioned a few of the things that I would like to ask further down the road, so we could develop on that.
Mhm.
So since now you may have an outside view of how the Fed is dealing with things, and you can talk about your opinions a little more openly. Do you think that the Fed is actually dealing with the current tightening slash easing cycle in a good way? Would you have pivoted a little earlier? How do you think they are currently handling it?
I give the Fed high marks on what's been an incredibly difficult business cycle to judge. So I think we can look back and say, well, inflation when it took off in 2021, it took off and then it spread, right? And there it wasn't just a transitory in sense of it's going to be gone in 6 months. It's not going to like spread to other sectors. It did widen out, and that meant the Fed had to go very quickly when they did start raising rates in 2022, and that was risky. It was disruptive. We saw some regional banks have a difficult time with that when the rates move so quickly. And so, in hindsight, going back, beginning to raise rates somewhat sooner, I think in particular ending the asset purchases. So the unconventional monetary policy probably could have been wrapped up at the end of 2020 and leave it just to stabilizing markets and not to, trying to really boost the economy. So in hindsight, you can go back. Do I think that the Fed raising rates 6 months earlier would have like meant we didn't have inflation? No. And most of the inflation was coming from the pandemic, the disruptions. The higher interest rates helped, just like a somewhat smaller fiscal package probably would have taken some of the demand out, some of the inflationary impulse. But the United States was going to have high inflation. Our peer countries had high inflation, and there were differences in approaches, particularly on the fiscal, how the US was very generous in fiscal support during the pandemic. And so I think we can go back and do better, and there should be lessons learned in terms of, particularly in inflation. Like we've got a lot to learn about inflationary processes and how they start and how they spread, how quickly, or in often the case how slowly they then heal, particularly when it's coming from the supply side. So I think we've just got a lot to learn on the inflation side. I think the Fed did a reasonably good job keeping up, and then when realizing that they had not really stepped in and taken an aggressive stance on the inflation, that they made up for lost time. So I think that's important. And then when I look at the place we are now, they are very committed to an easing cycle. They took a lot of time to get comfortable with it's time to start cutting interest rates, but this Fed definitely is a dual mandate Fed. I mean, the United States, both price stability and maximum employment are by law the uh, objective of the Fed. And I think, in particular, as inflation has come down, so we're not in a five-alarm fire with inflation, but as it has come down notably, and we've seen that labor market softening, the Fed has, been very clear that they're going to protect both sides of their mandate, and that's part of why they're, cutting interest rates right now. And I think it shows more balance and awareness of the Fed's role than many Feds of past. So they're not perfect, and there are plenty of mistakes, and I can find lots to quibble with. I mean, that's what you do is when you're part of the commentariat, you have to find things to quibble with. But given the challenges that they were facing, I think They've done a remarkable job. And one thing I will give particular praise to them, and maybe especially to Fed Chair Jay Powell, is I think at multiple points throughout this crisis, they have done an excellent job of communicating. They don't have all the answers. There's a lot of uncertainty. They haven't always chosen the right words, but they have done a remarkable job of holding our hands through what has been a very difficult, very confusing period in the US economy. And I think that like we needed that. So I give them high marks just for that.
Great insights. Great insights. Yeah. So you mentioned the dual mandate. So on one side, we do have the inflation target. He still mentioned the 2% target, even though we're not quite there yet, right? But it seems that he shifted the attention now to unemployment, right? So we had the 3.8, then back to 4.1. Do you see anything like, haven't we kind of forgotten because we're kind of gonna get there eventually and we don't need to pay much attention to that? Is that the feeling that you have right now, or can we actually deal with both at the same time?
Well, they're both the law, right? I mean, the Fed has a dual mandate. They do have to pay attention to both sides of the mandate. Now, there are times where one aspect of the economy is much further away from the target, right? That for several years we had when inflation was quite elevated, and the labor market was very strong and unemployment was very low. You had to look at it and say the problem we have is inflation is high, and that got a lot of focus. That didn't mean the Fed went from being a dual mandate to a single mandate Fed. It just meant that one side of their mandate was really having some trouble, and that got a lot of attention. And understanding that labor markets were strong, the Fed looked at it as, frankly, there was a period where we had labor shortages in the United States. The labor markets were almost too strong in the sense that we just have enough workers. It was very disruptive. Wages were getting bid up. That was feeding into prices. So there needed to be, and the Fed likes to talk in euphemisms, but they talk about the rebalancing. They needed a more balanced labor market. And the more balanced labor market, that really did fit with their fighting the inflation goals. It's just we've gotten to a place now where inflation is much closer to target. And many of the aspects of inflation that are still elevated, say with shelter inflation, has some very special stories that it's not like, oh, the labor market's overheating and that's why the owner's equivalent rent is higher. No, this is not what, these two things are not in conflict. There's some very specific stories of what's happening in inflation, and some of it's almost how we measure inflation. So like there's not this conflict now. The labor market is not causing this overheating that we'd worried about before, because the labor market has we're still adding jobs at a good clip. There's still a lot of dynamism in the US economy. It's just not firing on all cylinders like it was 2 years ago. And so Powell has talked about, particularly when they started the cutting cycle, that the US is reducing interest rates from a position of strength. So they didn't start cutting interest rates because like, oh, recession is coming. They started cutting interest rates because things had in the labor market were still good, but they were pointed in a direction that was a little worrisome, right? More, losing that. So it's kind of like cutting interest rates from a position of strength to protect that strength, right? The Fed shouldn't just wait until the bottom falls out to start acting. I mean, that's frankly far too late for them to have an effect. But it is it's a tricky, like, we don't really understand fully the trade-offs, if at all, if they exist at all, between inflation and the labor market. And there's certainly, we have some very, like, the details matter, and a lot of our macro tools aren't real good at details. So it's a challenging balancing act. And the Fed has, the way they have dealt with a lot of the uncertainties in this period is just being very heavily dependent on the data as it comes in on the US economy, as opposed to having a grand theory of how the economy is going to work. Now, there are some downsides to being really attentive to data, because data can be noisy and you can bounce things around. But I think given the constraints and the uncertainties that we've faced in the last 4.5 years is probably the right approach. But it does make, balancing out the two sides of their mandate is never an easy task, and it certainly has been challenging of late.
Yeah, yeah. And speaking of noise about data, because since you are an expert on the labor market, do you see we see some narratives about the labor market? Okay, it's pretty strong, but we got a lot of maybe full-time jobs and not as strong because people are replacing with many part-time jobs. Do you see that kind of trend? Do you think it's a negative trend? Do you think it's just the way that the labor market is going to be behaving from now on? What do you see in the labor market, like in detail?
This was a really interesting cycle in the labor market. I mean, if we remember when the pandemic struck, we had millions of people losing their jobs in the United States in a week, right? Like, I mean, you had this massive reduction in jobs. You had millions of people not losing their jobs, but walking away from their jobs. So we had a huge decrease in the labor force, which you see some of that in recessions, but this was just so outsized. Everything about this cycle was outsized in terms of the swings. And what that meant is it was also outsized in terms of the disruptions. So we saw massive job losses early on. And then as the economy began to reopen, we saw some massive job increases. And some of those people who'd left the labor force came back, but many didn't. Then we had labor shortages. Then we've had a period of a real big, a notable increase in labor supply. Some of that's been from immigration into the United States. Some of that has been from people coming off the sidelines. So like prime age women in the US have like all-time high labor force participations. Then you had workers coming in.
Mhm.
And through this whole process, we've seen patterns in the labor market. So like with full-time work, which we often think of as like good work, right? It comes many times with benefits and
Exactly.
think of it as a more stable job. So in this recovery, we saw a real surge in full-time work early on in a way that is not typical in recoveries from recessions. That was definitely not the case after the Great Recession. But then it also coincided with labor shortages, and you need people to work, and full-time jobs are just like how many hours are you working a week, right? So there presumably were labor shortages were tough on workers to some extent too, because the ones who were there were really like, you got to work, like we don't have enough people. So you saw a big surge in full-time work. Now it is true that over the past few years there's been a bigger increase in part-time work. Part-time work is not always a bad thing. Like it often is it can be a sign also of the flexibility that workers have. Like not everyone does a 40-hour a week job fit within their other life responsibilities. And so an important piece, we saw a big increase in women joining the labor force. They are overrepresented, particularly in like working years in part-time work. Like that's just kind of so like having the opportunity to have those part-time jobs. I mean, that is a sign of employers being willing to accommodate a worker who can work less. What we do watch, and it has increased over time. So when not everything is sunshine and roses in the labor market, but what
Mhm.
we watch are people who are part-time for economic reasons. So that's when they take part in the survey for our labor force statistics, they tell yes, I'm part-time, and they're asked, well, why are you part-time? It's like because I can't find full-time work. Now,
Mhm.
that is a category of part-time work that we pay a lot of attention to because it tends to rise when like the economy is in a bad place, right? And
Mhm.
it can often be a sign as that part-time for economic reasons increases. You can see that going into a lot of recessions. So when we've had some growth scares, particularly this past summer, looking at labor market data, and there were some signs like things were starting to drift up. So it's one of those, we're in this place of, if the labor market in the US would just kind of hit the glide path, and in particular we need to see hiring pick back up. That's been an area of
Mhm.
weakness that I find particularly disconcerting. But if we would more or less hit the glide path right now, things would be fine. It's just that softening, the increase, we'd had a very low level of part-time for economic reasons. So some increase, that's probably like getting back to normal after we've had a really strong labor market. But if it keeps increasing, that's a problem,
Mm-hmm.
right? So it's that slow. But so far, the cooling off in the labor market has been very gradual, right? Like that's not what we see in a recession or right on the edge of a recession. There, the cooling off is not gradual. So what we've seen is just a slipping away of that really strong labor market earlier in the recovery to something that is more sustainable. It's just we need to get it into a, I think in the months since the summer, when the labor market data looked pretty rough and the Sahm Rule recession indicator triggered, and like there were concerns over the summer about the labor market. We've gotten some better news since then, but it's choppy. Like we'll get a really good month of news, and then the next month is kind of confusing, and we've had weather events. Like it's hard right now to read how the labor market's in a good place, but what's hard to gauge is how sustainable that is, or how we, whether it really looks like we're going to stick the landing, right? We don't, and I think there's some confused, like there are some things I look at the labor market and I'm concerned, but in general, we're still in a good place.
Does that make you feel doubt your own tool, like from now on, based on how special or different this cycle was? How are you currently assessing the Sahm Rule?
Yeah, for well over 2 years, I had been explaining why the recession indicator, and I'll explain what it is, but why the Sahm Rule was likely to break this time. And over the summer, it did break. And what I mean by that is the recession indicator turned on and we weren't in a recession. Okay, so the Sahm Rule, what it is I look at the national unemployment rate. I take the specific formula of it. You take the 3-month average of the unemployment rate, because we never want to overreact to 1 month of data, right? So we kind of smooth things out a little bit. So you take that 3-month average, you look at the most current value of that series, compare it to the low over the prior 12 months. So how much has it increased? If it's a half a percentage point or more, historically, the United States has been in the early months of a recession. So it really isn't about forecasting a recession. It was developed as an indicator to say, hey, we're in a recession, fiscal policy, get going. I mean, that was the idea of the Sahm Rule. Now, it has a very, historically, if you go back to the 1970s, every recession since then in the US has had this feature. And the Sahm Rule typically turns on about 3 or 4 months into the start of a recession. So it's early days before we would have other standard metrics of a recession, and definitely before the National Bureau of Economic Research would call a recession, right? So it is early days. And then if you go back before 1970, in the late 1950s and the late 1960s, there were 2 times where the unemployment rate data at the time would have signaled, with the Sahm Rule, a recession, but there was no recession. Now, in those 2 cases, a recession came within 6 months later, but I mean, that's a whole other thing. The Sahm Rule is not a forecast. There were special circumstances. So why was I so concerned that the Sahm Rule was going to break? Okay, so the thing about the unemployment rate is we're pretty used to thinking about increase in the unemployment rate are a bad thing, and are often associated with a recession. Right. So you can have an increased unemployment rate if it gets a lot harder to find a job or people start losing their jobs. And so the unemployment rate goes up, and it tends to, what we see in recessions, it starts slowly and then it really picks up in terms of the unemployment. And the half a percentage point of the Sahm Rule, that's a really small increase, right? We would never call that a recession if it stopped at a half a percentage point, right? But it tends to, once a recession hits that level, you're starting to see things like 3 percentage point, 4 percentage point, 5 percentage point, like really much bigger increases happen by the end of the business cycle, by the end of a recession. So you have these changes in the unemployment rate that are typical in recessions. Now, but that's not the only reason the unemployment rate goes up. Another reason the unemployment rate can go up that isn't about recessions is if you have an increase in the number of people who are looking for work, if you have more workers, Well, and then sometimes it can take time to match up and find those jobs. Now, if you have a lot more people coming in and looking for work, that's not telling us, hey, a recession around the corner. Once we get those people jobs, that's telling us, hey, a boom is around the corner, right? We've got more workers, we have more labor supply. Okay, so what we had in this cycle was a lot of changes, big changes in the labor supply. So when we had the labor shortages, those were actually pushing down artificially the unemployment rate because we just didn't have enough
Mhm.
people. Like if you wanted to work, you had a job, right? And now we went into a period where we had a very big surge in immigration and also other people joining primate a big increase in prime age workers in general coming in off the sidelines. And that just overwhelmed the ability to kind of match up those jobs. So and what we've seen, and so then you had an increase in unemployment. The Sahm rule has no way to distinguish between
Mhm.
these two. It's because there's less demand for labor, and unemployment goes up, and there's more increase in labor supply, unemployment goes up. And honestly, over the summer, and more than the summer, but over the past year, we we saw both of those two things happening. We have had a softening up of the demand for labor. The hiring rate in the U.S. is back well below its pre-pandemic levels, um, but we also saw a lot of labor coming in. So the Sahm rule was onto something that the labor market has been weakening, has been softening up. Maybe some of that was necessary to be sustainable. It's just it hit that half a percentage point threshold with more than the labor demand softening. Like, so it kind of like it
Mhm.
had there was some story that's right there. Things have softened up in the labor market, uh, but it overdid it in terms of signaling we're in a recession, right? That half a percentage point. And subsequently, the unemployment rate has, I mean, it moved back down. It's kind of stabilized a little. It's still above where it was a year ago, but it moved back down enough that the Sahm rule untriggered. So the increase is less than a
Mm.
half a percentage point. So, so yeah, no, and I was very clear before the Sahm rule triggered and through the whole period. You know, I was clear when I was on Bloomberg Radio when it triggered, and I told him, I said, the Sahm rule says we're in a recession, and Sahm says we are not in a recession. And
Yeah.
it was also like, look around at the economy's growing, like GDP is growing, we're adding jobs. Like this is not, we didn't have a recessionary economy at any point in the last few years, but we have had a very disrupted, very unusual economy.
Got it. No, yeah, no, great explanation there. Thank you so much.
Mhm.
When I read your articles or content, I see. I don't remember if it was your Substack or not, but you mentioned that we needed more tools for the future than just the Fed alone, and that kind of triggered my curiosity. Do you? And at the same time, I'm not sure if you take that into consideration or not, but many people discuss how the yield curve is actually not in a great mood, or those swings up and down of the long
Mhm.
part of long end of the curve. How do you see that? Do you think that could be one indicator of what are, first of all, what are they telling us, and what kind of, and second, what do you think we would need, maybe beyond the Fed itself, or new tools for the Fed,
Mhm.
so we can really understand where we are in future cycles if they end up to be special like this one.
Right. So taking lessons learned about our macroeconomic toolkit is going to be tricky because there are this the past 4.5 years were unprecedented in many ways. I mean, having a global pandemic and a war in Europe in the same period put a lot of stress on the global economy and created an environment, particularly the pandemic, an environment that was just, not something we had seen in generations, disruptions that were uh really deep disruptions in the global economy and in very unexpected, like we hadn't seen these before. So we have to be a little careful. Like I don't take any economic tool, whether it's the yield curve, the Sahm rule, the Phillips curve, like I wouldn't like take any tool and judge it solely on the past 4.5 years, because we may not, like, this was just such an unusual set of circumstances. So we have to be careful about, the drawing lessons. Now, something like with I do think many of the macroeconomic tools, not just the Sahm Rule, but many of the macroeconomic tools have blind spots to supply driven variations in economic activity. I think there is a umbrella of lessons learned that fit in the supply space, that, because I mean, our typical, like, the blog post that I'd written recently about needing more in particular tools to fight inflation. Right.
Mhm.
So the tool that the Fed has, raising and lowering interest rates. Now they do this both, conventionally through the federal funds rate and
Mhm.
unconventionally through asset purchases, but it's the same idea. It's like moving around interest rates.
Just levers.
That is their lever. And what is their lever? It's a demand lever. Right? They're making it more or less expensive to borrow, to spend. Like, they're fighting inflation by less demand. Right. And that's by cooling off the economy. So, but the one of the issues, and there was a lot, there was a huge disruption in demand due to the pandemic. I mean, there was a lot of forced savings early on, and then there was an explosion of pent up demand when the economy reopened. Setting aside all the fiscal relief, everything else, like, we just had, and we had a shift in the kinds of demand from, you know, from an economy that was very service driven to then all of a sudden there was a big increase in demand for goods. And then as the economy reopened, we shifted back and there were services. I mean, it's just been a really complicated demand environment. So the Fed had a role to play in terms of trying to cool demand. But the problem is a lot of the inflation that we dealt with really didn't have to do with demand. There were pandemic disruptions to supply chains. We've heard all about those, the global supply chains.
Mhm.
But we can also think of the labor shortages, the people walking away from the labor force. That is also a supply disruption that created uh, a lot of stress in labor markets. It created a lot of pressure on wages and then on prices. The way that the pandemic turned just our life behavior upside down and backwards, right? Like, that was important. And then in the war in Ukraine, you had big disruptions in commodity markets. So the thing is that the Fed, it's not that, when we saw the disinflation, it's not that we had Jay Powell go out and start drilling oil, take a second job, unload the docks in LA, right? Like, these were not, like, the Fed can't go and didn't go and fix the supply side of the economy. They could help take a little bit out of demand to take some pressure off of it. But the big disinflation that we saw has come from the healing on the supply side.
Mhm.
But what that meant is, with some rare exceptions. So in the United States, we do have the Strategic Petroleum Reserve, and that was helpful in helping bring oil prices down somewhat, right? Like, so that was an intervention by the White House. But in general, when there's inflation, policymakers just look to the Fed and they're like, "You got this." And so with the disinflation that we've gotten, much of it has come through the passage of time, the healing of those, getting the supply chains back together. Now, again, demand cooling off some did take some pressure off it, but a lot of it was just sorting through the mess that the pandemic had wrought. And a big piece of this was getting the pandemic itself into a manageable place. Right.
Mhm.
And the pandemic, they give the Fed a hard time about inflation wasn't transitory. Well, it's like, guess what else wasn't transitory? Like, COVID was not transitory, right? Like, it came back in waves and it took time to get to a manageable place. And it wasn't just how the United States managed COVID. We're a globally interconnected economy. Like, it made a difference, say, the policy against COVID that was happening in China, which was quite different from the US by the time it got to the later stages of the pandemic. So, like, we didn't we didn't have the tools for the these supply disruptions. Now, will we see these kind of supply disruptions exactly again? Let's hope not. I mean, this was a very special circumstance, but we can think of other supply driven disruptions. I think people give examples in the kind of climate change related natural disasters. Like natural disasters can have a similar disruption to supply. And we've seen this before the pandemic as well, just not like large scale. So I think there's just this question, and there is a much more robust discussion happening now about other ways to fight inflation that aren't just the Fed and pulling on demand. But again, like we have to be careful with lessons learned, and there's a reason that central banks are the primary go-to with inflation. A lot of like fiscal levers that have been used in the past have a mixed record, I think would be the right way to put it. So this it may be that the way that we handled this inflation is basically as good as it could have gotten. Maybe starting raising interest rates a little bit earlier, maybe like little around the margins. But the reality may be, if we have disasters like the pandemic, like the war in Ukraine, we're going to have inflation. And then it's a question of, okay, well, what do we do if we're going to have an environment with inflation? How do we protect? How do we make the pain of that period as manageable as possible? And I mean, we're in the very early stages of having this conversation, but I think it's one that it would serve us well to have.
Very interesting. Yeah, that you mentioning the conflict with in Ukraine and the whole geopolitical panorama. So we're going to go through a lot of changes right now with the president as well and everything. How do you see that? Do you believe this is going to create a whole rupture on the strategy that has been done so far about the easing of the yield or on interest rates and everything? Do you think Jay Powell is going to change his stance on it, or just going to keep as if nothing has happened? How do you see that kind of transition into next year, starting next year?
So we are in a wait and see place. I think the Fed is taking what I think is a very healthy attitudes towards this. So Powell has been adamant that they need to see the details of, say, the tariff policy, the tax cuts, how the administration will interact with the Fed itself, right? They're going to need to see the details before they can build that into their policymaking. If setting those potential policy changes aside, looking at where inflation is, looking at where the labor market is, looking where the federal funds rate is, the Fed is of the view that they are still being more restrictive than is necessary to get inflation that last little bit down, right? The Fed funds rate is high enough. It is still putting downward pressure on the economy. And frankly, they're like, the economy doesn't need that much downward pressure. So we're going to keep cutting rates. So they have been clear, like direction of travel is clear. We're going to cut rates because the Fed is very, responsive to the data, and they are, a little c conservative institution. I mean, they're cautious. Central banks are cautious by nature. That's probably a good thing largely. And so they're not in a hurry, but they see this path of the rates are still too high. And there are real downsides if the Fed puts more pressure, downward pressure on the economy than is necessary. Like, growth is good, productivity is good, right? Like, so they need, having jobs is good. Inflation is bad, but inflation is not the end all be all, and particularly not at a Fed that has a dual mandate, right? So the Fed is clear about their direction. They're being cautious about, exactly how far they'll go in their cuts. Are they going to cut in December? Do they pause? But I mean, the basic idea is like they still see themselves as needing to get out of the way, getting interest rates down. And they're treating the policy changes, the potential policy changes after the election, as on the horizon, but not something that they should be reacting to. And I agree with that because there is a really wide, like, the US is a $30 trillion economy. The policy changes that are being discussed could be really substantial, but they don't necessarily have to be really substantial. Some of, especially with the tariffs, the way they're negotiated, the way the negotiations shake out with other countries can have a big effect on what, the actual tariff policy looks like. And so, and you don't want to overreact to one input to the US economy. And particularly, so I think, like, the Fed is cautious by nature. And so I think this just adds, there's another set of risks with the change in the administration, and they're kind of in the hopper, but there's such a range of outcomes that, I think it's probably hard for them to let those potential outcomes change their decision making now. But what I'll say is, I mean, the Fed does not have their head in the sand. There are staff that are already hard at work. I mean, I know this from having been across other presidential transitions at the Fed. Like, as soon as something becomes a possibility, resources are put into understanding that possibility inside and out. And those are resources that policymakers have as they decide when to kind of bring that into their thinking. But like that, but that means that the Fed will be well positioned when we do start to get clarity on what those policies look like, are likely to be, then that will fold very quickly into the, like, this is not the Fed's first rodeo
Mhm.
at going across a presidential transition. And often presidents come in pushing big policy changing ideas. And, so you just have to not, like, they don't need to overreact to it. It is unfortunate that some of the ideas that are getting thrown around actually involve the Fed directly. That makes, and I think the Fed has been like, Jay Powell at this point seems absolutely allergic to talking about the tariff policies or anything that might be construed as his
Mhm.
judgment on the policy proposals from the incoming administration. And I think, it's sad that we're, like, at this point, but there's a lot of animosity being directed at the Fed that could be very fundamentally damaging. And that's um, at least in modern times, that's uncharted territory for
Mhm.
the Fed to be in. So they're doing a little dance, especially in public, to stay away
Mhm.
from angering uh, the Trump administration. But we'll see how that goes. So,
Yeah, yeah, no, he was very, very clear on not talking about politics at all, and not get involved in that for sure. Yeah, just our last question. I know that your time is very
mhm,
valuable. So we see a lot of liquidity in the markets, and you mentioned how the interest rates are still maybe too high in the U.S. And we see a lot of capital just flowing into the U.S. to the SP 500, right? All equities and all risk
mhm.
assets, Bitcoin at all-time highs. What do you make out of that? Do you think it's just rate differentials, or do you see something in the rest of the world that it's not maybe that great when you compare it to the United States? How do you see on a global liquidity perspective if we just not look at the U.S. in isolation and we take like a global perspective, in your opinion?
Mhm. Right. Well, it's always a fool's errand to take a complicated market movement and try to tell a simple story with it. So as that caveat, it has been the case, not, and this is not just since the election, but the United States has been exceptional in the recovery from the pandemic. And in particular, if you look, so I think a lot of this story comes down to growth and the growth outlook. So we've had, the US has been really growing even in an inflation adjusted sense, notably through particularly relative to our peer countries, has been experiencing growth that is really notable. And it's not just this, like, uh sugar-induced fiscal spending growth, right? Like, you also look under the hood and things like labor productivity in the United States just look really good. Now that might fade away, but we've seen real gains in the US, whereas you look to a lot of our peer countries and they're really struggling in their growth space. And I think there's a lot of reasons why that could be, or has been the case, and why it could be going forward. But we do, in terms of since the election, you've seen, say, a big, I mean, the Fed started cutting interest rates, and at about the time the Fed started cutting interest rates took off, right? So we've seen, and we've seen equity markets perform very well, and a lot of this is some of that growth scare over the summer turned out to just be that, a scare, but not a reality. And so, and the Fed started cutting, so it's like, well, we're much less likely, or we're much more likely in the United States to avoid that recession outcome. Right. So there's a strength in the US economy, kind of taking what downside risk off the table. So that was important. And then we do see, I mean, I think the read of policies after the election is pretty tricky. So if you look at different analysts, they'll make assumptions, which the Fed said they don't want to do this. The Fed does not want to make assumptions. But if you're thinking about the policies that have been proposed, you got to make assumptions about, like, okay, what was a campaign thing and what's like a reality thing? And that has, the general view is that we've got policies in place that are probably going to be good for growth, and certainly, things like lower taxes, and like there are things that look like they're good for growth generally, but there's definitely things that look like they're good for shareholders, and that,
Mhm.
the US is a place to put your money, with the lower taxes, is in particular. But then, some of the policies are talked about, like a broad-based tariffs, in particular, if they ended up in a, trade retaliation back and forth, these are not growth enhancing. Right. So it's like there are some policies that are being put out there that are in their more extreme. And it often looks like the assumption is these ones that are really bad for growth. Oh, they're not going to do that. They say mass deportation of immigrants, but they're not really going to do that because that would be so bad for growth. And I don't know, like, that's a pretty optimistic view because, good or bad for growth isn't necessarily why these were put on the campaign list to start with. So I think we're still in a place where markets in general, and maybe they've softened up a little bit, and like, sobered up a little bit in the last week, but in general it does look like there's, looking to the growth prospects, the outlook, those investment returns. And then the US does have, I think, a leg up in the technology space where we still have some future growth. So, like, there are reasons to be optimistic. I'm not sure there are reasons to be as optimistic as markets, but that's not my space. and to and again, it's complicated. And this has been like, this trying there's been a lot to process for markets, not just in the last 4.5 years, but also as you get into a change in administrations that could be pretty fundamentally different. And the verdict so far looks to be pretty positive from the market side, but markets can turn on a dime.
True story. Claudia, thank you so much
Mhm.
for your contribution today on so many invaluable information. And just for us to wrap up, how can people actually find you and understand more of your work?
Yeah, so I do more writing at Stay at Home Macro, so Sahm, the play on my last name. So my Substack is a good place to look. I write a Bloomberg opinion. I'm also on both Twitter and Blue Sky to some extent, and LinkedIn. But for something like to read and kind of think about, Substack's probably the best place.
Awesome. Thank you so much, Claudia. You have a wonderful day. Appreciate that.
Great. Thank you. You
Thank
too.
you.